Early February 2026 presented several notable developments across equity markets, cryptocurrency assets, inflation data releases, and corporate earnings announcements. The S&P 500 index approached the 7,000 level for the first time in its history. Bitcoin experienced a pullback from January highs. Inflation data came in below analyst expectations, and major technology companies reported quarterly results while announcing substantial capital expenditure plans. This analysis examines these concurrent developments, the structural factors connecting them, and the range of conditions that could influence market trajectories in subsequent months. The analysis will proceed in 5 parts. First, the confirmed market data and economic releases from early February 2026. Second, the context for equity market performance, including sector-specific drivers and valuation considerations. Third, cryptocurrency market dynamics and the factors influencing price movements. Fourth, inflation data interpretation and monetary policy implications. Fifth, scenario mapping based on different paths for corporate earnings, inflation trajectory, and capital expenditure cycles. The S&P 500 index traded near 6,835 during early February 2026, approaching but not yet reaching the 7,000 level. This represented continued appreciation from prior months, driven primarily by technology sector performance. The index advance reflected a combination of factors, including corporate earnings results, artificial intelligence infrastructure investment announcements, and market expectations regarding Federal Reserve policy. Bitcoin prices declined approximately 9% during the first half of February 2026, moving from around $75,000 to approximately $68,250. This pullback followed a strong advance during January. The decline occurred alongside increased profit-taking activity after the prior month's gains. Analysts noted that the $68,000 level represented a technical support zone that some participants considered a potential stabilization point. Silver prices traded in a range between $80 and $90 per ounce during early February, after testing the $100 level in late January or early February. The consolidation pattern following the approach to $100 suggested a pause after rapid appreciation. Physical market premiums and lease rates showed mixed patterns during this consolidation period. Alphabet reported fourth quarter fiscal 2026 financial results with revenue of $113.8 billion and profit of $34.5 billion, exceeding analyst forecasts. The company announced plans to invest between $175 billion and $185 billion in artificial intelligence infrastructure during 2026. This capital expenditure commitment represented a substantial increase from prior years and reflected the company's strategic prioritization of AI capabilities and competitive positioning. Nvidia scheduled its fourth quarter fiscal 2026 earnings announcement for February 25, 2026. Analysts anticipated strong results driven by demand for the company's Blackwell chip architecture. Pre-announcement share price movements showed a gain of approximately $1.49 in pre-market trading, reflecting investor positioning ahead of the earnings release. United States inflation data for January 2026, released on February 13th, showed month-over-month inflation of 2.5%, below the analyst consensus expectation of 2.6%. The lower-than-expected reading was interpreted positively by market participants, as it suggested inflation pressures were moderating toward the Federal Reserve's target range. This data influenced expectations regarding the trajectory and timing of potential Federal Reserve interest rate adjustments. The equity market performance near the 7,000 level on the S&P 500 requires examination of the composition and drivers of the advance. Technology sector companies represented a substantial portion of the index's market capitalization and contributed disproportionately to the overall index gains. The concentration of returns in a relatively small number of large capitalization technology companies created a pattern where index performance diverged from the median stock performance. Valuation metrics for the S&P 500 at these levels showed elevated price-to-earnings ratios compared to historical averages. Forward price-to-earnings ratios, which incorporate analyst expectations for future earnings, remained above long-term means. However, these elevated multiples reflected several factors, including the composition shift toward higher growth technology companies, expectations for sustained earnings growth driven by artificial intelligence applications, and the interest rate environment. The relationship between equity valuations and interest rates operates through the discount rate applied to future earnings. When interest rates are lower, future earnings are discounted less severely, supporting higher present valuations. When rates rise, the discount rate increases, applying downward pressure on valuations. The February 2026 environment featured interest rates that had risen from pandemic-era lows but remained uncertain regarding their future path, depending on inflation trajectory and Federal Reserve policy responses. Alphabet's capital expenditure announcement of $185 billion for 2026 represented a strategic commitment reflecting competitive dynamics in artificial intelligence infrastructure. The scale of this investment indicated the company's assessment that AI capabilities would drive competitive advantage and revenue generation in subsequent years. However, such large capital commitments also create financial obligations and expectations for return on invested capital that the company must eventually satisfy. The implications of this investment scale extend beyond Alphabet to the broader technology sector and semiconductor supply chain. Investment of this magnitude creates demand for data center equipment, networking infrastructure, power systems, and specialized semiconductors. This demand influences companies throughout the technology supply chain, including semiconductor manufacturers, equipment suppliers, and energy providers. Nvidia's position as a primary supplier of AI-specialized semiconductors placed the company at a critical node in this investment cycle. The February 25 earnings announcement carried significance not only for Nvidia shareholders, but for market participants assessing the sustainability and scale of AI infrastructure investment. Strong results and forward guidance would reinforce narratives about sustained demand. Weaker results or cautious guidance could prompt reassessment of valuations across AI-related companies. The Bitcoin price movement from $75,000 to $68,250 represented a 9% decline following January appreciation. Several factors influence cryptocurrency price dynamics, including institutional adoption patterns, regulatory developments, macroeconomic conditions, and technical trading patterns. The early February decline occurred in a context where profit-taking after January gains represented a plausible explanation. Though distinguishing between profit-taking, strategic repositioning, and fundamental reassessment requires examining additional indicators. Cryptocurrency markets show sensitivity to risk appetite in broader financial markets. During periods when equity markets advance strongly and risk assets generally perform well, cryptocurrencies often benefit from similar positioning. Conversely, when risk aversion increases or when macroeconomic uncertainty rises, cryptocurrencies may face selling pressure alongside other risk assets. The early February period showed equity markets near highs, suggesting that cryptocurrency weakness occurred despite rather than because of broader risk sentiment. Regulatory developments continue influencing cryptocurrency market conditions. Clarity or uncertainty regarding regulatory treatment in major jurisdictions affects institutional participation decisions. Corporate treasury allocations, exchange-traded product approvals, and banking sector engagement with cryptocurrency custody all depend on regulatory framework stability. Any developments in these areas during early February could have contributed to price movements, though specific regulatory announcements would need to be documented to establish causal connections. The inflation data release showing 2.5% month-over-month inflation in January 2026, below the 2.6% expectation, influenced market expectations regarding Federal Reserve policy. Lower than expected inflation readings support market participants who anticipate that the Federal Reserve may pause rate increases or potentially reduce rates if inflation continues moderating. However, single monthly readings represent limited information compared to sustained trends across multiple months. Federal Reserve policy decisions incorporate multiple factors, including inflation trajectory, employment conditions, financial stability considerations, and assessment of economic growth sustainability. A single below-consensus inflation reading provides one data point but does not determine policy outcomes. Market expectations regarding future Federal Reserve actions are reflected in interest rate futures pricing, which showed modest shifts following the February 13th inflation data release but did not indicate dramatic policy reassessment. The January 2026 inflation reading of 2.5% represented progress toward the Federal Reserve's 2% target, but remained above that target. The question for policymakers involves whether inflation will continue moderating to 2% or whether it will stabilize at levels somewhat above target. This assessment depends on factors including wage growth, housing cost trends, services sector inflation, and expectations embedded in pricing and wage-setting behavior. Energy prices, goods prices, and services prices each contribute differently to overall inflation. Energy prices show high volatility driven by global supply and demand. Goods prices faced deflationary pressure during 2023-2024 as supply chains normalized after pandemic disruptions and as demand shifted back toward services. Services prices, particularly housing-related costs, showed more persistence due to structural factors including limited housing supply and sticky rental contract dynamics. Multiple scenarios exist for how markets may evolve depending on corporate earnings, sustainability, inflation trajectory, and policy responses. Scenario A involves sustained equity market advance supported by earnings growth. In this scenario, corporate earnings continue growing, driven by artificial intelligence applications generating productivity gains and revenue opportunities. Technology companies, including Alphabet and Nvidia, report results that justify elevated valuations through demonstrated revenue growth and margin expansion. Capital expenditure investments translate into operational improvements and competitive advantages. The S&P 500 advances beyond 7,000 towards 7,200, 7,400 over subsequent quarters. Inflation continues moderating toward 2%, allowing the Federal Reserve to maintain stable policy without additional tightening. Bitcoin stabilizes near $68,000 and resumes gradual advance as institutional adoption continues. Silver consolidates in the 80-95 range before attempting another advance toward $100 on industrial demand. Conditions required for Scenario A include corporate earnings meeting or exceeding elevated expectations, artificial intelligence investments demonstrating clear return on investment, inflation declining to 2% range within several quarters, stable interest rate environment, and sustained risk appetite among investors. Indicators include strong quarterly earnings beats, expanding profit margins particularly in technology sector, declining inflation readings, stable or declining interest rate expectations in futures markets, and increasing institutional cryptocurrency adoption metrics. Scenario B involves valuation compression and market correction. In this scenario, corporate earnings fail to justify valuations at current levels. Technology companies report results showing that capital expenditure investments are not yet translating into proportional revenue or profit growth. Competitive dynamics in artificial intelligence lead to margin pressure as multiple companies pursue similar opportunities. The S&P 500 declines 15 to 20% from the 7,000 level toward 5,600, 5,950 as valuations adjust to more sustainable levels. Inflation proves sticky above 2.5%, forcing the Federal Reserve to maintain restrictive policy longer than markets anticipated. Bitcoin declines toward $55,000, $60,000 as risk aversion increases. Silver retreats toward $70, $75 as speculative positioning unwinds. Conditions required for Scenario B include corporate earnings disappointing relative to expectations, evidence that AI investments face longer payback periods than anticipated, inflation remaining persistently above 2.5%, Federal Reserve maintaining or increasing interest rates, and risk aversion spreading across asset classes. Indicators include earnings misses, particularly among mega-cap technology companies, declining profit margins, inflation readings remaining elevated, interest rate futures pricing in additional tightening, and broad-based asset price declines. Scenario C involves divergent performance across asset classes. In this scenario, equity markets show mixed performance with technology sector weakness, offset by strength in other sectors. The S&P 500 trades in a range between 6,500 to 7,000 without clear directional trend. Corporate earnings meet expectations but fail to accelerate, resulting in sideways price action as valuations remain elevated but do not expand further. Inflation gradually declines but remains modestly above 2%, leading to Federal Reserve policy stability without cuts or increases. Bitcoin shows volatility, but trends modestly higher towards $72,000 $75,000 as institutional products drive adoption despite macroeconomic uncertainty. Silver advances toward $95-$100 driven by industrial demand growth in solar and electric vehicle sectors. Conditions required for Scenario C include mixed corporate earnings, with some sectors strong and others weak, moderate progress on inflation toward but not reaching the 2% target, Federal Reserve maintaining current policy stance, and selective investor positioning based on sector-specific factors. Indicators include dispersion in sector performance, with technology showing weakness while other sectors strengthen, inflation moderating gradually but slowly, stable interest rate environment, and cryptocurrency adoption metrics continuing to improve. The implications vary across market participants and asset allocators. Equity investors holding positions near the 7,000 level on the S&P 500 face decisions regarding whether current valuations reflect sustainable earnings trajectories or whether concentration risk in large-cap technology creates vulnerability. Diversification across sectors, geographies, and market capitalizations affects exposure to different scenarios. Cryptocurrency holders who purchased near $75,000 experience the early February decline and must assess whether the pullback represents healthy consolidation or the beginning of more substantial weakness. Position sizing relative to overall portfolio and risk tolerance becomes relevant for managing volatility in this asset class. Precious metals holders who accumulated silver during its advance toward $100 face similar assessment regarding the 80-90 consolidation. Industrial demand fundamentals versus speculative positioning determine whether current price levels represent sustainable support or temporary pause before either advance or decline. Corporate management teams making capital allocation decisions must evaluate artificial intelligence infrastructure investments against alternative uses of capital, including share repurchases, dividend increases, or acquisitions. The $185 billion commitment from Alphabet represents a specific strategic choice, with implications for shareholder returns and competitive positioning. What remains uncertain includes the trajectory of corporate earnings in subsequent quarters, the effectiveness and return profile of large-scale AI infrastructure investments, inflation's path over the next 6 to 12 months, Federal Reserve policy responses to evolving economic data, cryptocurrency regulatory developments in major jurisdictions, and industrial demand sustainability for silver and other commodities. Key variables to monitor include quarterly earnings announcements, particularly from mega-cap technology companies, capital expenditure execution and returns from AI investments, monthly inflation data releases and their components, Federal Reserve meeting statements and policy decisions, cryptocurrency institutional adoption metrics and regulatory developments, and commodity market physical indicators, including industrial consumption data. Changes in these indicators signal which scenario is developing. early February 2026 presented a confluence of developments across multiple markets. Equity indices approached historical highs driven by technology sector performance and AI investment narratives. Cryptocurrency markets experienced pullback after January strength. Inflation data came in modestly below expectations, influencing policy expectations. Major corporations announced substantial capital commitments to AI infrastructure, while scheduled earnings announcements carried significance for validating current valuations. To summarize confirmed elements, the S&P 500 traded near 6,835, approaching 7,000. Bitcoin declined approximately 9% from $75,000 to $68,250. Silver consolidated between 80 to 90 after approaching $100. Alphabet reported Q4 revenue of $113.8 billion and profit of $34.5 billion, while announcing $185 billion in 2026 AI investment. Nvidia scheduled earnings for February 25 and January 2026. Inflation came in at 2.5% below the 2.6% expectation. What remains uncertain includes whether corporate earnings will sustain elevated valuations, the return profile and competitive dynamics of large AI investments, inflation's trajectory toward or away from the 2% target, Federal Reserve policy evolution, and asset price sustainability across equities, cryptocurrencies, and commodities. The variables that matter most include corporate earnings, growth rates, particularly in technology, capital expenditure productivity, and competitive advantage creation, inflation persistence or moderation, interest rate expectations, and risk appetite across asset classes. These factors determine whether markets extend recent advances, correct toward more sustainable levels, or show divergent performance across sectors and asset types. This period illustrates the interconnection between corporate investment cycles, monetary policy conditions, and asset price dynamics across multiple markets. We will continue tracking confirmed developments in earnings announcements, economic data releases, and policy responses.